Okay, this is a run through of the top 5 charts of the week. Just going to talk through each of the charts and explain why I picked them, what else you need to think about, and maybe just go a little bit beyond the little paragraphs of the weekly email. This is, by the way, from the email that goes out to subscribers of the mail list. I'm going to put a link to this in the video section, so there's a link there that you can subscribe to it. But anyway, straight on to number 1, Philly Fed fake out. What is that? So Philly Fed is a regional PMI in America, obviously for Philadelphia, from the Philadelphia Fed rather, so it's for that region there. Very much like the ISM PMI, and it's one of the things that makes up this broad economic confidence composite that you can see there in the dark blue line. I'm just going to click that link there, which I've actually linked to there. So if you are a regular viewer, you would have recognized this chart from a couple of weeks back, and we can see it here. US economic optimism, recession or reset. You'll notice that Philly Fed's actually part of this, and that the other parts of it are TIPP, ISM non-man, ISM manufacturing, NHP consumer, small business, good spectrum of things. Point of this exercise here is just to survey the surveys and try and get a consensus of where economic optimism is. And the idea is that we're seeing this big reset here, and again back to that one, the sort of point that I've made there, or the kind of set of options really is, well, this is either a recession or a reset. So there's two theories there, and we'll come back to that in a second. So first glance on this chart, hopefully something will stick out to you, the same thing that stuck out to me, and that's that the Philly Fed is very much more erratic and prone to more extremes than the consensus of other indicators. And I thought this was quite interesting because, to borrow a sort of concept from markets, the concept of turning points and exhaustion of trends, whenever you have a real big move in the Philly Fed, and particularly when it moves to an extreme, so a large move and a move to an extreme, it often actually signals a exhaustion point of the previous sort of like trend, and in many cases an actual turning point. So if you look back just for this sort of recent history here, in the late 90s there you had that large drawdown in the Philly Fed that, it was a very sharp move and a move to an extreme as to where it was previously, and that turned out to be a sort of an exhaustion point or a trend changing point. Again in 2001, premature as it turned out in terms of the overall wider sort of basing process then. And again in 2008 there was this exhaustion of that initial move, which was followed by the that little bit of a fake out rebound, fake out to the other side. And then throughout sort of the ranging years, you've had that signal lighting up as well. We had it actually lighting up in the initial part of the reflation there, when the initial wave was kind of done with. So I think that this is quite an interesting indicator, quite an interesting signal, particularly against the backdrop of pretty real fear, pretty probably well-placed fear, or at least speculation that there could be a recession. We've definitely seen a slowdown, and you can see there that across the consensus of indicators that there has been quite an abrupt reassessment of the outlook. Market volatility obviously didn't help. So I mean, what it's brought me to, at least, is that maybe this is as bad as it gets, at least in the short term. So maybe the reset theory has a bit more legs to it. There is a couple of examples here where the signal was kind of right, but it won in the short term, but it was actually just the start of a wider breakdown. So in many ways, it's like a sentiment signal in the market. So definitely one to have on the radar. We'll see how it turns out on the next print. But anyway, we'll move on from that one into another chart that was actually featured in that same report, the blog post or email, whatever you want to call it. So China credit flow, so that's when we first included that one. Looked pretty interesting at that time. And then you look at the February print there, looks pretty uninteresting. So what's going on here? Well, in January we had this massive spike in total social finance growth. Standardized it against GDP, so that a figure back in 05 is comparable to a figure now in 2019. And what that did was put it into context. It was a pretty large expansion, not out of the ordinary, particularly for that time of the year. And if we just jump back to that one, note what I've written here. So key will be to see what happens in the February and March credit growth numbers to get the real picture. And already, we've got the February picture here. Did note here that we need to see February and March. February had Chinese New Year, which, basically all of China was out for a week, at least a week. It's kind of like their Christmas period. They have, that the sort of holiday time where everybody goes home and comes together as family and takes a bunch of time off work. So all the factories shut down, all the banks close. So it's quite understandable in that context that it wouldn't be, on the same magnitude. The fact that it is so much lower is definitely going to create some doubt about the whole stimulus. So that's why I said China, what stimulus? So yeah, as I mentioned, we kind of do need to see those February numbers before we can start getting, making any strong conclusions about whether that stimulus is actually coming through or whether they actually need to have a bit more economic pain before they'll step it up on that area, because there's a lot of competing agendas in China at the moment. On the one hand, they want to deliver, and on the other hand, they don't want their economy to run out of steam, so they want to also stimulate where necessary. So I'll leave you with that conundrum, the China conundrum. And on to the next one, China again actually. And in the red line we've got the China PPI, Producer Price Index, year-on-year basis. So what I noted there is, here we go. I'm just going to read this out because I kind of captured it pretty good. China PPI inflation has moved decisively towards deflation, as we can see there. And that could be a problem for emerging markets. Why? Well, let's start off by having a little bit of a study of this chart. If we look at periods where PPI inflation was accelerating, especially from a low point, or where it was just chugging along, PPI inflation or accelerating PPI inflation, those tended to correspond to pretty decent periods of performance for emerging markets. And there's a whole lot of pretty sound fundamental reasons for that. And the trouble is, if you look at periods where, well, there's two periods where PPI sort of sends a bearish signal or warning signal. One is when it gets too overheated, and that precipitates a bit of policy tightening, such as 08 or 07 rather, and then again in 11, etc. The other situation is deflation. So it's that period of deeper deflation in 15 that kind of precipitated that decline in China and emerging markets. And this, when we saw this prolonged period of sustained deflation, all emerging markets could do was trade the range. Now, if you can pick the peaks and troughs, the swishing and swashing back and forward within the range, and you can leverage that up, then then good for you. But if you're trying to pick these larger moves, then picking these broader macro moves are going to be pretty key. So this move down into deflation at the moment, well, how about we take the opposite view? What actually would cause you to discount this or to ignore it? Well, probably the previous chart. So if this kind of deflationary trend that we're seeing here continues and worsens, then that's going to precipitate a bit of policy easing there, or a bit more policy easing, which is going to put a tailwind for pretty much the whole EM commodities complex. And then the other really important aspect of that is something completely different, which is US Fed US dollar, because PPI inflation obviously very sensitive to commodities. Commodities very sensitive to US dollar. You can pretty much map the US dollar to that, or change in the US dollar. US dollar looks to be near the end of its cycle, might not be quite at the end of its bull cycle, but pretty much near the end there. And that's the other key moving part there. But looks like it's having a go, having a crack, trying to make another sort of last laugh in this bull market. And that's created another set of challenges for EM. Number 4, this is a sort of an unusual chart, maybe even a little bit of a controversial chart. So what I've got here is price seasonality chart. And what do we mean by that? It's the average seasonal historical pattern by business day across the year for the period 1986 to 2018. So this is basically how the oil price has traded on average in the past across the year. That's an average. Averages can deceive. Also, seasonal patterns can break down. It might be, for example, that 9 years out of 10 markets traded exactly like this. They went up in the first sort of part of the year there, went sideways in the middle of the year, had another little run, then declined into the end of the year. It might be that markets did that 9 years out of 10, but then in that 1 year out of the 10, the year that you go to put on a trade to try and take advantage of that seasonality, it does the opposite. So hence I've said there, seasonality is pretty much supposed to be like a cherry on the top of an existing investment thesis. So if you already got a bullish view on crude, which I happen to have, then you'd look at this and be like, good, that's going to help the case from a timing point. So that kind of reinforces that. That red line is just year to date. Some people are going to look at this chart and get a bit stroppy because it's got 2 different axes, but pretty much it's just to show you roughly where it's been trading. Doesn't mean to be taken literally, as in it's not a forecast that it's going to go to 75 by the end of the year. Already said that it might end up going like this and then do the opposite, or might end up rising at that part instead of falling. So there you go. Seasonal tailwind for oil about to come online. Again though, US dollar is a bit of a potential curveball, so got to watch out for that one. Number 5, capital market assumptions. What to expect with expected returns. This is a new chart that I'm pretty excited about. It's got an extract from my new capital market assumptions dataset, and basically calculated expected returns volatilities for I think 26 different asset classes. Going to be adding to that over time depending on client demand. And yeah, but what I did was I thought I'd pick out some of the main ones. A few people do this, but I thought I'd add my 2 cents to the mix. And what we've got here, I've just picked out US equities, developed excluding US, emerging market equities on the growth asset side, And on the, I haven't included any alternatives or anything else. And on the fixed income side, just got US Treasuries and cash, and US cash rather. So this is in basically USD hedged terms. So in terms of the FX aspect, and you can see there probably, hopefully, three things should stick out to you. Number one is obviously on the growth side, the equities. There's two bars here that are in a completely different stratosphere versus this one down here. And there's a few things driving that. For developed ex-US, they actually get a hedging premium, so pick up, and it's also expected to be, so the way I work out the hedging premium is basically it works out to be the expected FX change as well. So even if you were to say, yeah, but what about the unhedged version? Well, it's basically the same. But anyway, you do get a hedging premium there, an expected hedging premium, and you also get a valuation tailwind, US valuation headwind. The growth, expected growth, is actually higher in America than developed ex-US. But then if you look at emerging markets, I'll probably put up a chart of a breakdown here. But for emerging markets, obviously the expected growth is a lot higher. Nominal growth is expected to be a lot higher than for US or DM. But because of the interest rate differentials, the hedging premium, well, it's a hedging discount, so you get an FX headwind there. And dividend yield, there's not that huge amount difference between them. There is a difference, but those are the main drivers of the difference there. And EM obviously also has a big valuation tailwind, pretty similar size, but a little bit larger, I think, than DM ex-US. Point is, these two are, the relativities there, it's pretty clear. Other relatives are, if you look at US equities versus fixed income in general, a little bit higher than treasuries, so that's nice to see that there's an equity risk premium there, almost about the same as cash. So that, I mean, when we're earlier in the cycle, that was not, you could not say the same thing. The other thing within fixed income, you'll notice that treasuries is actually lower than cash, what I've got for my cash forecast at least. And that obviously creates another sort of tension or dynamic in terms of it kind of, if you think about some of the traditional asset allocations benchmarks and the set and forget approaches, if this pans out as expected, probably not going to be the optimal outcome. So definitely something to think about, something to spur a little bit of consideration. If you use capital market assumptions in your work and you want to get the full set from me, or if you want me to help you develop some, definitely get in touch. Can provide some input there. Or if you want to look at anything else that I'm doing, definitely also get in touch. And other than that, if you just want to tag along and look at these interesting charts, be sure to subscribe to this email list and also the YouTube channel.